This happens more frequently than you might think. Not declaring money that you owe people, not declaring properties that you have, thinking that if you don't say anything about it, nobody's going to find out. So my advice is to quit looking to real estate to be the magic pill to get you out of the financial disaster that you're in.
So you're curious, what can I do to help fail at getting funding for my next real estate deal? Well, you, my friend, are in luck, because I'm going to tell you many ways that you can make sure you screw up your loan and don't get funding for your next deal.
The first thing you can make sure you do is during your actual application process, once your loan has been submitted, go take out a bunch of new debt and don't tell your loan officer about it. Underwriters love this. When they underwrite and we get your debt to income exactly at the maximum amount it can possibly be, and then you go buy the most expensive house that you could possibly afford, then you take on new debt that completely screws up your debt to income ratio. This frequently happens when people get really excited about buying a new house and go buy a new car to go along with it and finance all of it. Or they want to buy a bunch of furniture to go along with the house, and they go take out a new line of credit at the furniture store. This is a great way to screw up your entire deal as well as the work that everybody else put into trying to make it happen for you. Another way to fail at getting funding is to lie on your loan application, assuming nobody's going to look into it. This happens more frequently than you might think. Not declaring money that you owe people, not declaring properties that you have, thinking that if you don't say anything about it, nobody's going to find out. Eventually, underwriters do trace all this stuff back, and you can get in big trouble by lying on a loan application. Another great way to fail at getting funding is to cut corners when filling out the loan application. Do I really have to put all that information? I don't want to go look that up. Let me just spitball it, but you're saying that that's actually what you have, and you don't tell your loan officer that you spitballed it. A great way to make sure you screw up your funding is to shop lenders in the middle of having a house under contract. Here's how it looks. You take the time to fill out the loan application, you build a relationship with the loan officer you have, you go into contract, and then your greed kicks in and you go, I'm supposed to close in 14 days on this house, but what if that person can get me an eighth of a point less? So you go ask that person, what's your rate? And of course they know if it's not lower than the one you have, you're not going to switch. So what do? They lie. Or they fabricate the truth. They come in and say, I can get you this rate. You then try to switch in the middle of escrow to a new lender, a new underwriting system, a new loan application. You have to do the whole thing over, but you only have 14 days to get there. You don't end up getting it done. You have to go to your agent and have them negotiate a longer escrow for you. You burn your relationship with the first loan officer that you have. You probably jeopardize getting the deal at all. And then you find out at the closing table that the reason that they gave you that lower rate is you actually have higher closing costs than you did with the first one. The first lender could have given you the same rate or better if you paid origination fees. And that's all that the second one did, is they stuck some closing costs in there, didn't tell you about it, to get your rate lower, but your overall cost of the loan is higher. Happens all the time. This is a great way to make sure that you fail at getting a loan and funding your real estate deal. Another great way to fail at funding real estate is to not have any money when you go try to buy it. Now look, I know there are very specific certain cases like buying a property subject to or using some no and low money down strategies where you can get away with not having money and buying real estate. But this usually doesn't happen on conventional loans. In fact, it rarely ever happens. And everyone wants conventional loans because they have the best rates and the best down payment options. So when you're trying to combine these creative methods with getting the best interest rate you possibly can, it's a recipe for disaster. It hardly ever works. If you want to get the best loan product like conventional loans, you're going to have some money set aside. You're going to have some discipline in your life where you've saved money, and you're probably going to have a stable job. So my advice is to quit looking to real estate to be the magic pill to get you out of the financial disaster that you're in, and have an honest conversation with yourself about how you ended up in that financial disaster and what you can do to get out of it. Another great way to fail at getting funding for a loan is to have money put into your bank account in the middle of the time that your loan has been submitted for processing and not tell anybody where that money came from. See, in our minds, we often think it doesn't matter. I have the money, so I have the money. But banks operate under certain regulations, many of them which came into play during the Patriot Act, where the government wanted to prevent terrorist organizations from laundering money through the United States. And an easy way to do that is by giving money to somebody who then uses it to buy a house. And then the person who lent the money has a portion of their dirty money in that deal and owning equity in the property. So because of that, lenders now have to go back and trace, we call it sourcing, the money that goes into your account, where it came from, why it's there, and it should be declared to show up somewhere on your taxes or somewhere else. So getting a loan from someone and not telling anybody when you're in the middle of having your loan process is a great way to make sure you screw it up completely and you don't close on the house. A great way to screw up your funding is to try to negotiate seller credits from the seller that are higher than what your actual closing costs are. See, if you're not working with a good lender, they might not tell you that you can't receive more credits from the seller than what your actual closing costs are for the house. So if your closing costs are $15,000, you can only receive a credit from the seller in the amount of $15,000. Now, we have lots of creative ways that we can make that number higher for you, and I talk about that with a lot of our clients, because if you've negotiated $30,000, you don't want to lose the $30,000. But you can screw the loan up really big if the deal falls apart because you negotiated more seller credits than what you actually have in closing costs to be eligible to receive them. All right, that wraps up my video about how to make sure you screw up getting financing for real estate if your goal was to blow your deal up in the middle of escrow or make sure that you cannot fund real estate. I hope this helped.